Okay, welcome back to Accounting 101. In this video, we are going to go over the solutions to the Chapter 10 assignments. Chapter 10, to remind you, a review is entitled Investments. So we had review questions 1 through 11, I believe. So, what is a debt security? A debt security is an investment in notes or bonds payable issued by another company. The investor is loaning money to the investee. The investee is going to pay interest over the life of the bond or the note. And then at the maturity date, pay back the amount borrowed. Debt securities represent a creditor relationship with another company or government entity. They typically pay interest for a fixed period of time at a fixed rate and a face value or maturity value at the end of the term. 2, what is an equity security? Well, an equity security is an ownership interest in another company. You buy stock in the other company. And we'll have more about that in Chapter 13, the different types of stock. Okay. Sometimes the stock will pay a cash dividend, and sometimes, hopefully, the market value of the stock goes up or appreciates in value. That can also happen with bonds. The value of bonds is inverse to the interest rate relative to the face rate of interest on the bonds. Why would a company invest in a debt or equity security? Well, a couple different reasons. And the first one would be that the company may have some short-term excess cash that it doesn't need for maintaining day-to-day operations and cash flow needs. So this should be invested to get a maximized return on it. Cash in the bank lying idle is not generating any. May also earn interest from debt investments, dividends from equity investments, or increase in market value from either type of investment. The company may invest in debt or equity securities of other companies to pursue certain business strategies. For example, a company may invest in a key vendor's debt or equity securities to further enhance the business relationship between the two. Doing so might strengthen the investing company's supply chain source. Number 4, review question 4. Briefly describe the specific types of debt and equity securities. Well, with debt securities, we have the trading category, and they are short-term, days, weeks, or months, with the intent of generating a profit on a quick sale. Buy it low, sell it high, or sell it higher. May not always be the case. Trading debt securities are categorized as current assets on the balance sheet. Held-to-maturity debt investments are debt securities that the investor company intends to hold and has the ability to hold until their maturity date. Depending on the maturity date, held-to-maturity debt investments are categorized as either current or long-term. They will be current in the year within 12 months of the maturity date. Other than that, they would be long-term assets. Available for sale debt securities are debt securities that don't fall into either category. It's the default category. They're not trading debt securities. They're not held to maturity. They're in between. Okay, the investor does not plan to hold the security until maturity, but again, they also did not buy it with the intent to sell it within a few months or less. They are reported as current assets on the balance sheet if the business expects to sell them within 1 year. Otherwise, they are shown as long-term investments, long-term assets. As far as equity securities go, we can say there are 3 categories. When we have less than 20% we have no significant influence over the companies whose stock we own. Okay. They're reported as either current assets or long-term assets, again, depending on management's intention at the time of purchase, or if they change their mind, they can convert it between current asset and long-term asset. If we own between 20 and 50% of another company's voting stock, it is said that we can exercise significant influence over that corporation. In that case, we use the equity method of accounting form, picking up our share of their net income or loss, and also when dividends are paid, we pick up the dividend income but reduce the investment account. They would be shown as long-term assets on the balance sheet, obviously. Finally, if we own over 50% of the voting stock of another corporation, we have what they call a controlling interest. And in that case, we account for it by filing consolidated financial statements, which means we absorb all the accounts of that subsidiary company into our financial statements. 5, how is the purchase of a held-to-maturity security at face value recorded? It's recorded at cost, including any brokerage fees paid. The account held-to-maturity investment is debited and cash is credited for the amount paid. Simple. Review question 6. When disposing of an available-for-sale debt investment, where is the gain or loss on the disposal reported in the financial statements? That would be in the other income or loss or other income or expense category on the income statement. If you remember back to chapter 3 or 4 when we had the multi-step income statement, we have operating expenses, net up the top would be sales, net sales, less cost of goods sold is gross profit. Then we'd have the operating expenses broken down between administrative or selling and administrative expenses. And that would give us operating income. And then from that, we would show interest expense and then other gains and losses or other revenues and expenses. And then income tax and then net income. 7. What method is used for investments in equity securities when the investor has significant influence and typically 20 to 50% ownership? Briefly describe how dividends declared and received and the share of net income are reported. Well, as we just said earlier in response to review question 4, I believe, it is called the equity method of accounting for an investor's stock, and the investor records its of the dividends declared and received. There's a decrease to the equity investment account, picking up the revenue, okay, or picking up the cash of the dividends. Debit cash, credit the investment in equity securities. The investor records its proportionate share of the investee's net income or loss by increasing the investment account or decreasing the investment account respectively, and crediting revenue from investments. It's that simple. Again, think of it as something that can be inflated. As the company grows, your investment is, unless you make an additional investment, let's say it's 25%. Well, you have 25% of a bigger company. When you pay dividends, the company gets smaller because of the outflow of cash in the form of dividend payments to shareholders. So we have to reflect that. When the company has net income, it gets bigger. We have to increase our investment account to signify that our 25% is now 25% of a bigger company. If the company has a loss, it's going to shrink. So we would credit the asset investment account. Okay, number 8. What method is used for investments in equity securities with more than 50% ownership? Briefly describe this method. That would be controlling interest, and we would use consolidated financial statements. Okay, consolidated financial statements combine the balance sheet, income statements, and cash flow statements of the parent company with those of its controlling interest in its affiliated companies, its subsidiaries. The final outcome is a single set of financial statements as if the parent and its subsidiaries were one and the same entity. 9. What adjustment must be made at the end of the period for the trading debt investments and available for sale debt investments? Well, we want to reflect their fair market value. So an adjustment will be made at the end of the year to bring the investment accounts up to their or down to their market value using the unrealized holding gain or losses. I think I'm answering question 10 here. And the fair value adjustment account that will modify the investment account. Okay. 10. Where on the financial statements is unrealized holding gains or losses on trading debt investments reported? And they would be reported on the income statement. And question number 11. Where on the financial statements is an unrealized holding gain or loss on the available for sale debt investments reported? And that would be not on the income statement, but rather as a directly increasing the equity section of the balance sheet in an account called accumulated other comprehensive income. And again, the difference is when it hits the income statement, it's going to get over to the retained earnings statement, equity section of the balance sheet. In that case, it's available for payment and distribution of dividends. When it's in other comprehensive income, it is not available for dividend payments. All right, well, we have short exercise 2, 3, 4, 5, and 6. All right. So what do they want us to do in number 2? Scroll down here so I can read it. All right. On January 1 of 2024, Chaucer's Restaurant decides to invest in Lake Turner bonds. The bonds mature on December 31, 2029, and pay interest on June 30th and December 31 at 4% annually. The market rate of interest was 4% on January 1, 2024, so the $90,000 maturity value of the bonds sold for face value. More on that in Chapter 12. Chaucer intends to hold the bonds until December 31, 2029, which is the maturity date, so they're going to be accounted for as a debt investment held to maturity category. So, what are we required to do here? Journalize the transaction related to Chaucer's investment in Lake Turner bonds during 2024. Okay, let's just put up your short exercise 10-2. And the first thing we have to do on January 1, record this purchase of the bonds. Held to maturity, debt investment. And we paid cash for them. So there's the accounts. Debit the asset called held to maturity debt investments. Credit the asset called cash. How much? $90,000, because they didn't give us any information about any broker fees involved. Maybe we bought them directly from Turner. I don't know, Lake Turner bonds. And that was to record the purchase. Now on June 30th, we have to pick up the interest payment. Well, the interest payment is, the interest rate is 4% of the $90,000 face value of the bonds. So 90,000 times 0.04 is $3,600. I'll put this on the paper shortly. But remember, the bonds pay interest twice a year, so we have to take half of that amount. So that would be $1,800. put it down here before I put the accounts in. Working backwards a little bit, but maybe you can see it better that way. Times 4% times 6/12. Okay, so there's the face value of the bonds, $90,000, 4% annual rate, 6 months over 12 months, you get $1,800. Now, what is that? Well, that's an interest payment. So we're going to debit the asset called cash, and we're going to credit an account called, guess what? Interest revenue or interest income. I believe our book uses interest revenue, so I'll be consistent with them. Either one would be sufficient or would be correct. Debit cash for $1,800, credit interest revenue for $1,800. Same thing at December 31st. All right. Number 2 requirement. In what category would Cjhapter report the investment on the December 31, 2024 balance sheet? Well, if it's 2024 and the bonds mature on December 31st, 2029, and they're in the held to maturity category, they would be classified as a long-term investment. And they would continue to be reported that way until the year 2029, which is the year of maturity, at which time they would be shown on the balance sheet as a current asset. Short size. All right, short exercise 10-3. Accounting for equity investments. Last one was a debt. Now we're dealing with stock. On January 1, 2024, Bark Company invests $10,000 in Roots Inc. stock. Roots pays Bark a $400 dividend on August 1, 2024. Bark sells the Roots stock on August 31, 2024 for $10,450. Assume the investment is categorized as a short-term equity investment and Bark Company does not have significant influence over Roots Inc. That information is important because it tells us what category the asset is to be accounted for as. It's not the equity method because we don't have significant influence, so it also follows we don't have control. Control would be very significant influence, would be control. So this is a fair market value recording of a equity investment. Let's get the date down here, January 1, 2024. Journalize a transaction for their investment in Roots stock. Okay. So what do we get here? $10,000. So we have an asset account called equity investment. And I like to highlight it or hyphenate it and put the name of the investee in there. That would be Roots Inc. And it was for $10,000. And we paid cash for it. And that would be to record the initial purchase of the stock. One asset being exchanged for another asset. Asset cash given up to acquire the asset investment, equity investment in Roots Company stock. On August 1st, we had a dividend payment made to us. Roots paid a dividend and told us it was $400. So we're getting cash of $400. So we'll pick up that with a debit of $400 to the cash account and $400 credit to the dividend revenue account. Okay, now it said on, excuse me, on August 31, we sold it. For $10,450. August 31st, we are going to get cash of $10,450. We have to take the equity investment in Roots Inc. off our books. So we will credit that account to get rid of it. And it was in there at $10,000. So if you notice there, I've got $10,450 in debits and $10,000 in credit. So I need to put $450 more dollars in the credit column so that my debits and credits will equal. And if we're giving up something worth $10,000 and we're getting something worth $10,540, namely the stock and the cash respectively, the difference of $450 would be a gain on disposal or gain on sale of stock. Gain on sale of investment or something to that order. Okay, now what number 2 says, what's the net effect of the investment on BARK's net income for the year ended December 31, 2024? Well, let's see. We made $400 in dividends. Dividend income. And we had $450 gain on the sale, excuse me. So altogether, there would be a net increase in net income of $850. $400 from the revenue, dividend revenue, $450 gain when we sold it. Okay, moving right along. The next one is short exercise 10-4. Let's see what they're saying here. On January 1, 2024, Bryant Inc. decides to invest in 3,750 shares of Farrier stock. I don't know if they meant it here, but a farrier is another name for a blacksmith, a horse that primarily does horseshoeing. So I see you learned something in the accounting class today. Okay, so the stock was selling for $16 a share when they got it. On August 1, 2024, Farmer paid a 70-cent per share cash dividend to shareholders. On December 31, 2024, Farrier reports net income of $50,000 for 2024, and assume that Farrier has 15,000 shares of voting stock outstanding during 2024, and Bryant has significant influence over Farrier. So we're going to use the equity method of accounting here. So let's say requirements number 1, 2, and 3. Identify what type of investment the Farrier stock is for Bryant. Well, we already said it's they say we have significant influence. Let's do the test for the. We bought 3,750 shares out of a total outstanding shares of 15,000. So that's 25%. And we're going to need that number, that percentage later on. What do we got to do here? Generalized transactions related to Brian's investment in Farrier stock during 2024. Okay, so the first thing that happened is we bought the stock January 1, 2024. Okay, so we're going to get equity investment. Farrier Inc. And let's see, how much did we bought 3,750 shares, and the price was $16 a share. So that would be $60,000. Purchase of 3,750 shares of Farrier Inc. at $16 per share. All right, now you see the notation there? I like to do that because later on when we sell it, we know what the price is that we paid for it, so we can compute the gain or loss. When how many shares we have. It's always good to know. More information is better than less information. You may not need it, but when you have it, write it down for the future in case you need it. So on August 1st, Farrier paid a 70-cent per share dividend. Okay, so we own 3,750 shares times 70 cents. That's $2,625. So we're going to get cash of $2,625. And what does that do? Well, that's a distribution of net asset called cash by Farrier. So the company is getting smaller. So we're going to reduce our asset equity investment in Farrier by that amount. Okay. Maybe it would be good to put a notation there. Say, receive dividend on stock investment accounted for by the equity method. Can't see it because I wrote real small. I'll hold it close. Received dividend from investment accounted for using the equity method. December 31st, we pick up, since it's an equity method investment, we pick up our proportionate share of their income of $50,000. So what does that do? It makes the company bigger since they had net income. So we're going to increase our asset account equity investments in Farrier for our 25% of the net income. Net income was $50,000. 25% is 1/4 of that, or $12,500. I'm just going to show you half of this right now. Then say 25%. of net income of Farrier of $50,000. Okay. Company had net income of $50,000. We own 25% of the company, so we pick up 25% of the $50,000. So our investment, our 25%, is now 25% of a bigger company. So we want the investment account to be bigger, which we will do with this, which this debit will do. The thing is, why I did it this way, I want you to think of what we need to balance out. Well, everybody by this stage of the semester should know that debits and credits have to be equal. So we're going to credit $12,500. But think while I'm doing that, what account would that go into? Well, what is it? It's revenue from an investment. So, hey, let's call it that. Revenue from investment. You could call it revenue from equity investment, Farrier Company. Okay. So, that's it for that one. All right, what do they want to say? In what category and at what value would Bryant report the investment on December 31? The balance sheet. Well, let's do a little T account here. Well, clearly it would be as a long-term asset, right? So let's see what would happen to the investment account over the year. I'm going to show you step by step. There's the asset account, equity investment in Farrier. On the first, $60, the original purchase. On August 1, there was a dividend payment, so we picked up cash of $26.25, and we're going to reduce the investment account by $2,625 because the company is worth less. Now, again, what does that transaction do on that dividend? Let's go back up there. $26.25. The asset cash goes up by $2,625. The equity investment in Farrier goes down. So it's a wash. The company, we are Bryant Inc. After the dividend payment, Bryant is in the same position. They're not richer, they're not poor. Their asset composition is different. Their asset investment in Farrier went down by $2,625, but their cash account went up by $2,625. So the total assets, the total net worth of Bryant has not changed. The composition, December 31st, we pick up our proportion, our 25% of their net income, $12,500. So now our balance at the end of the year would be $69,875. And that would be reported as a long-term asset. Next, we have short exercise 10-5. And let's see what that holds for us. Accounting for debt investment. Okay, so they keep switching between bonds and stocks on us. On February 1, 2024, Bell Company decides to invest excess cash of $16,800 by purchasing a Grant Inc. bond at face value. At year-end, December 31, 2024, the fair value of the bond was $19,600. The investment is categorized as a trading debt investment. All right, so what do they want us to do here? Generalized transactions for investments in Grant Inc. at 2024. Okay, so February 1, we buy it, and so we have to record it, and it says a trading debt investment, so let's use that as our asset account, investment account, trading debt investments. And we paid cash for it, and it told us $16,800. Purchase the investment. Now on December 31, let's see, I'm going to draw a T account down here. Let's see what we have to do. Debt investment. And we're going to have a fair value trading account to modify that. Adjustments. Trading. Okay, so we have $16,800 in that account as of February 1. I'll show you what I got. I'll hold it up there so you guys can get up to speed with it. And then it tells us at December 31, fair market value of grant bond investment was $19,600. Okay. Now, what did we pay for it? Our basis or our cost is $16,800. So we have to ask ourselves, did it go up in value or down in value? Well, obviously it went up in value. If we paid $16,800 for it, and now at the end of the year it's worth $19,600, it went up $2,800. Right? It went up $2,800 increase. That's important. So we have $16,800 purchase price, and we have this account ready to modify that, and it has a debit balance, and it went up, so we are going to debit the fair value adjustment account. If it went down in value, we would credit the fair value adjustment account. So we do an entry to debit the fair value adjustment account. Trading category. And we are going to put unrealized holding gain or losses, holding gain or loss, trading category. So based on this calculation, it went up $2,800 in value. We haven't sold it yet. We're still holding it. So this is unrealized holding gain. So the fair value adjustment account gets a debit. So when you look at the investment account plus the balance of the fair value account, we are now at $19,600 fair value of this investment, taking these two balances together. This entry is how I got that $2,800 in there. I didn't put a T account for the unrealized holding gain or losses. Okay. Now, some people, the book, some problem will say it unrealized holding gain or unrealized holding loss. Well, why use two accounts? Let's use the one account, and whether we debit or credit it will tell us whether it's a gain or loss. Be efficient. Why have another account if you don't need it? Now, what else are they asking for here? In what category and at what value should Bell report the asset on the December 31, 2024 balance sheet? In what account would the market price change in Grant's bond be reported, if at all? Well, Bell would report the asset trading debt investment at its $19,600 fair value. And that would be classified as a current asset as it's in the trading category. The $2,800 increase in the market value of Bell's investment would be reported in the unrealized holding gain or loss trading account, and it would be shown on the income statement since it's a trading category. If it was available for sale, it would be not on the income statement, but a direct increase to the equity section of the balance sheet using other comprehensive income account. Okay, so there would be an increase. Number 3, they ask what was the net effect, if any, net income. It would be a $2,800 increase in net income, although it's an unrealized increase. We haven't sold that bond yet. All right, finally, we have 10-6. Short exercise 10-6. Let's go see what's going on here. Accounting for debt investments. On June 1, 2024, Josh's Restaurant decides to invest excess cash of $54,000 from the tourist season by purchasing a Jackrabbit Inc. bond at face value. At the end of December 31, 2024, Jackrabbit's bond had a market value of $51,200, so it's less than what they paid for it. The investment is categorized as an available for sale debt investment and will be held for the short term. Okay, so we have to record the sale, and then we have to record the fact that its market value went down right before, as part of our adjusting process at the end of the year. So we report the correct amount. So June 1, we buy it. So put it in the appropriate category, available for sale debt investment. And we paid for it with cash, $54,400. That's to record the purchase. Now, at the end of the year, it went down from $54,400 to $51,200. More minus 51,200. So it went down $3,200. Okay, so how do we show that? Well, we use that fair value adjustment account. But the last one, we were dealing with trading securities. Now we're dealing with available for sale debt security. But the mechanism is the same. We're going to have a fair value adjustment. And again, I'm draw a T account here so we can see this a little bit better. And this would be available for sale, debt investment. fair value adjustment available for sale. So here's our initial cost of $54,400. Haven't done anything here yet, but we know it went down in value, and it went down in value by $3,200. So this is an asset. This is an account that modifies the asset. It can either increase it or decrease it depending on what side you put the number in, the debit or credit side. If it's going down and it modifies an asset, you'd want to credit it. So if we put $3,200 credit balance in the fair value adjustment account, the combined value here is now reflective of the market value of $51,200. So let's do the entry. Fair value adjustment. Available for sale. And unrealized holding gain or loss, which in this case would be loss. And there's the entry. Unrealized holding gain or loss available for sale. Very important that you designate whether it's a trading category or an available for sale category investment. $3,200 credit for the unrealized holding loss and a credit to the fair value adjustment, so we can reduce the value of the asset account available for sale debt. So let's see. In what category and what value would Josh Restaurant report the asset on December 31 balance sheet? Well, it would be an available for sale, and it would be reported at its fair value of market value of $51,200. It was classified as a short-term asset on that December 31, 2024 balance sheet. And the $3,200 market price change in Jackrabbit would be reported in the unrealized holding gain or loss account available for sale account. And this would be reported under accumulated other comprehensive income in the stockholders' equity section of the balance sheet for that year. It is also reported under other comprehensive income on the statement of comprehensive income. That's beyond the scope of this course. It's also recorded in the fair value adjustment available for sale account as shown in that T account that I did. All right. What is the net effect of the investment on Bell's net income for the year ended December 31, 2024? Well, it has no effect on the net income because it's in the available for sale category. Okay? It is not included in net income. It does, however, reduce equity because we make a negative adjustment, a negative entry for the equity section of the balance sheet. So, again, that would be shown on the statement of accumulated other comprehensive income, but it doesn't appear on the income statement. That statement of other comprehensive or other accumulated other comprehensive income would be an explanation of the equity section of the balance sheet. So the balance sheet would show common stock and any paid in capital in excess of par, retained earnings, and then other comprehensive income and other comprehensive income in parentheses. You would see note 10 or 11 or 12, whatever note, and then in that note you would explain that you had an investment in available for sale debt security that went down in value during the year, and it's thus reported a $3,200 reduction into the equity section of the balance sheet. Okay, that about does it. So enjoy and review it. Look at this tape a second or third time if need be. Again, just don't copy these down. Try to work them and see if you get the same solution. And I try to offer a little explanation of them. And that's it. And I'll be watching for the next lecture or the next video, which will be the lecture on chapters 11 and 12 dealing with liabilities.